The pitch sounds appealing and deceptively simple at first glance. Dividend money arrives in your bank account like clockwork, and you imagine freedom unlocked by passive cash flow. But reality is more complicated than monthly deposit notifications and polished marketing slides. This video begins with a single question that unsettles comfortable assumptions about income and wealth. Most online claims boil down to one simple statement: you need dividend ETFs only. That statement relies on two seductive promises that speak directly to human anxieties about security and control. The first promise is predictability, because regular dividends feel like guaranteed income even when markets are volatile. The second promise is emotional. Income feels tangible, and tangible things feel safer than abstract gains. People misjudge paper gains because they are invisible until realization events occur, while dividends land as sensory deposits to be spent or reinvested. This psychological bias toward cash income can lead investors to overweight dividends, even when the underlying companies are deteriorating. The rest of this video will unpack why that bias is powerful and often misleading. Before we argue for any strategy, we must define terms and stakes clearly in plain language. Dividends are periodic cash payments made by companies to shareholders representing a share of profits or discretionary returns. Total return captures both dividend income and capital gains or losses, and it represents the full change in an investor's wealth. Understanding this distinction will change how you evaluate performance across decades instead of quarters. There exists a long-standing debate in investing circles between income-focused and total return approaches. On one side, dividend investors point to steady cash flow, lower volatility, and built-in discipline. On the other side, total return advocates emphasize compounding, reinvestment, and sector diversification advantages. But the right answer is not binary, and it rarely ends with the phrase, "only dividend ETFs." Each approach has trade-offs that play out over different time horizons. The decision should hinge on goals, time horizon, taxes, liquidity needs, and psychological tolerance for volatility. There are clear scenarios when a dividend-focused strategy makes practical sense and aligns with goals. Retirees who need predictable cash flow to cover living expenses often prioritize dividend income above everything else. Similarly, conservative investors who prefer lower portfolio turnover and visible income may find dividend ETFs calming and efficient. Dividend focus also suits portfolios with specific income targets, where yield coverage and payout stability matter more than hypergrowth. Certain sectors like utilities or consumer staples historically offer reliable payouts and defensive characteristics that complement a dividend sleeve. In short, dividend investing fits when income predictability is an explicit objective. By contrast, total return tends to outperform in environments that reward innovation, growth, and reinvested profits. When companies reinvest earnings into high-return projects, instead of paying them out, shareholders often receive a larger long-term payoff through capital appreciation. Technology and healthcare sectors often exemplify this reinvestment advantage over long horizons. Another structural advantage of total return is compounding reinvested gains when dividends are not paid. Reinvestment turns retained earnings into future high-growth opportunities instead of immediate consumption. This compounding effect magnifies wealth over decades and often outpaces comparable dividend yields. So how should you evaluate dividend strategies before committing capital or conviction to them? Start by looking beneath headline yields to assess sustainability and quality. High yields are not inherently good. Sometimes they signal business stress, investor panic, or unsustainable payout ratios that precede cuts. Key metrics include payout ratio, free cash flow trends, balance sheet strength, and dividend growth history, rather than single-year payouts. Sector concentration risk also matters because a dividend ETF overloaded with a single falling industry can destroy capital, even while paying out. Always consider the macroeconomic context as well, such as rising interest rates or recession risks. To ground these ideas, we need concrete examples of both strategies and their outcomes over time. Consider a legacy telecom or utility that once offered high yields, but saw stagnating revenues and share price declines. Investors who chased yield sometimes lost principal while collecting diminishing dividends over years. Contrast that with a technology company that reinvested profits and compounded returns through sustained earnings growth and share price appreciation. Shareholders who focused on total return and reinvestment often experienced superior wealth accumulation, despite receiving no dividend. The difference is less about morality and more about what the company does with its cash. ETFs provide practical ways to access both dividend income and total return exposure with efficiency and diversification. Dividend ETFs can offer curated exposure to high yield or dividend growth strategies across many companies and sectors. Total return ETFs replicate broad market baskets that capture both capital gains and any distributed income. Popular dividend ETFs differ by philosophy, from high yield, high dividend growth to dividend quality screens that emphasize payout sustainability. Meanwhile, broad market ETFs like total market funds provide low-cost, diversified exposure that historically delivers strong long-term returns. Understanding these options lets you choose instruments that match your objectives and constraints. Building a balanced portfolio rarely means choosing one extreme over the other, and most investors benefit from a blended approach. A core total return sleeve can capture long-term growth advantages, while a satellite dividend sleeve can provide cash flow and defensive ballast during downturns. The right allocation depends on your goals, timeline, and tax situation. Practical rules of thumb include maintaining adequate emergency liquidity, matching income needs with predictable sources, and avoiding overconcentration in yield, chasing sectors. Rebalancing discipline prevents dividend sleeves from growing accidentally into overweight bets that misalign with original goals. Transparency about fees and tax consequences further refines decision making. There are clear warning signs that should make you pause before committing to dividend-only strategies. If your dividend ETF promises yields far above market norms, investigate the holdings, payout ratios, and recent fundamental changes that could explain the premium. Often, extraordinarily high yields are a bet on corporate distress or unsustainable yields. Avoid dividend-only approaches when your priority is maximum long-term wealth accumulation for future financial independence. Young investors with long horizons usually benefit more from total return compounding and lower fee structures. Conversely, retirees with immediate income needs can justify dividend emphasis, but only after careful stress testing of payouts. The philosophical conclusion is simple but profound. Income is attractive, but wealth is the true source of freedom over time. Dividends are a tool, not the ultimate objective, and their value depends entirely on the context in which you use them. Aligning strategy with goals, time horizon, and psychological comfort produces better outcomes than ideological devotion to any single metric. If this video changed the way you think about dividends and total return, take one practical step today. Evaluate your current holdings against your stated goals and time horizon. Simple actions like rebalancing, checking payout ratios, or adding a core total return ETF can materially change long-term outcomes and protect you from yield traps. If this gave you a new perspective, hit subscribe, share with a friend who loves dividend debates, and leave a comment with the strategy you want us to analyze next.